Okay, now we are live back in the Scale Up to Succession Plan Summit, and I am joined now at 4 p.m. by Tanya Ibberson from FD Business Services. And you are definitely last but certainly not least in our speaker lineup today, because the financials are obviously extremely key in buying and selling businesses. And in fact, they're actually the root of actually calculating a valuation of what your business is worth. So they are highly important in buying and selling businesses. And I know you're going to talk to us a bit about that in a moment. So thank you very much for joining us today. It's really important. And obviously you're coming back at 7:30 for the live Q&A session as well. So I'm just going to stream your presentation in, and then I am going to hand over to you.
Fantastic. Well, thank you very much, Emma. Thank you for having me. It's nice to know, and last but not least, I've got a huge lineup of incredible speakers to follow. So I'm really privileged and pleased to be here talking to you today. I'll give you a little bit of information about me by way of an introduction. My name is Tanya Ibberson. I'm an accountant and business mentor. I've worked in the accountancy field for all of my working life, which is coming up to show you my age, 24 years now. So it feels like I've been doing it forever. It really is part of who I am. And my background has been a mix of working in practice with clients alongside working in financial training. So a lot of the work that I end up doing with my clients is a combination of the two. And it means that I can spend a lot of time explaining, helping to make sure that clients understand exactly where they are with their financials, as well as taking care of things like compliance issues for them as well. Predominantly, I've worked with medium and small-sized businesses, but the main reason I left corporate, which I've got there on my bullet points, 10 years ago now, I've been working for myself, was because I hated the bureaucracy of working for bigger organizations and the focus on hitting targets and utilizations and winning new business and just the constant pressure on bigger and more and better. So I just felt that my skill set and what I absolutely loved was to work with clients to help them understand more about their businesses, understand more about how to put robust financial foundations in place within their business. And I could do that a lot better if I was working under my own steam. So 10 years ago, I set up by myself, and I haven't really looked back. I love working with my clients. What I found over the years, although predominantly I've worked as an accountant, the role that I have with them has been more along the lines of hand-holding, kind of an FD in your pocket type service that people can dip in and out of. And that's more of what I focus on now, is just exactly what is it that clients need. The compliance is fine. Some clients need more help, some clients need less. And that's exactly the sort of thing that we see when we're looking at the situations that we're going to be doing today in terms of buying and selling businesses. And that's why I'm here. So the Scale Up to Succession Plan, I come into this to talk about the financial side of things, as well as a little bit on the operational side. So to start with, the focus here is just exactly what the importance of long-term planning is for a business. Emma mentioned earlier on today, and Joanne did as well, actually, about thinking about your long-term plans for the business. What exactly are your ultimate goals going to be? In terms of selling a business, this should be looking at planning that between 1 to 3 years prior to the actual date when you're wanting to sell. The reason for that is that you need to make sure that we've got a track record that you can put into place to show potential buyers. But ideally, we need to be looking at the long-term planning from the start of your business, really, because it affects all of the decisions that you make from a financial point of view. So that might boil down to how you're going to finance your business, whether you're going to invest a lot of money, of your own money into your business to get that going, whether you're going to look at debt financing, or investors, or the shareholders and external investors. So having a goal when you start makes those sorts of decisions not necessarily easier, but certainly gives you more of a framework with which to work with. Ultimately, in terms of your planning, again, Emma has talked about this today as well. So are you looking to bring in family members to help running the business, or are you going to be more like a carry type individual? Are you going to be longer term thinking about running your business and then just winding that down? So are you going to be more Charlotte, or are we going to be looking to build up the business over the years with a view to selling? In which case we're going to be looking at being more Samantha, which is a great way to look at it. I love the analogy there, Emma, by the way. In terms of growth plans as well, these can actually help your ultimate plans for selling if you're looking to potentially grow organically. So quite happily over the years through word of mouth or through marketing that you might be doing. Or are you looking to buy other businesses? Are you looking to buy blocks of fees, for example, dependent upon what business that you're in? Are you looking to purchase businesses outright, purchase all of their assets, or share purchase? And Joanne talked about different examples of those earlier on as well. All of those things form part of the longer term plan. And having those in mind when you're setting up in business from the start will just help throughout all of the decisions that you're making. It helps with purchasing decisions. It helps with setting up systems. So these are all important things to have in place. What I see in a lot of cases, particularly with female entrepreneurs, and a lot of my clients fall into that category, are that the financials, the number side of a business can be quite daunting or overwhelming, particularly if those business owners don't have that background, don't have that information or that experience for themselves. The usual thing that I hear is, oh, I'm no good with numbers. Oh, I'm no good with the financial side of things. I let other people look after that side of things. And that's something that we'd like to change. It's certainly something that I like to focus on with my clients. And ultimately, the first step towards removing that fear, removing those limiting beliefs and mindset issues, which of course Rebecca talked about earlier on, Becky, is to arm ourselves with knowledge. So the first port of call is to know exactly where you stand in business. And we can remove that fear and those limiting beliefs just by exactly that, facing up to where we are. Where do we stand financially? Where do we stand with our financial accounts, with our taxation position? And we can help ourselves considerably along the way by having systems in place that can take care of that for us, rather than doing these things manually. And that takes all of the emotion and any mindset issues out of the situation. So part of what we're going to look at over the next few slides, specifically looking at selling and buying business, is exactly how you're going to go about doing that. So go on to the next slide. So I'm going to start off by talking about planning to sell. We've got a little bit of a recap there. I've already talked about how important it is to have this plan as early as possible, ideally from the beginning, although that's potentially not always that feasible. Quite often you find that you might start a business, and again, some of the examples that we've heard today with some of the early speakers were along the lines of sometimes they start as side hustles, sometimes they start as just something that you might do, maybe even as a hobby, and then things grow over the years. Maybe it's something that you find you really, really love, you've got a lot of passion for what you do, and things just grow and scale over time. We want to be making sure that you give yourself enough time when we come to planning to sell. Again, we talked earlier on about the 1 to 3 year time frame for making sure you've got enough time to put the foundations in place with a view to making your business as attractive as possible for a potential buyer. And we can do that by looking at different operational and foundational financial foundations to put in place. Those sorts of foundations that we're talking about linked particularly to financial management reporting and information. So that might include things like budgeting and forecasting. It's important to get into the habit of forecasting in your business, not only from the point of view of knowing exactly what's coming up in the next 6 months, 12 months, 3 years from now, but also from a cash flow point of view, which is obviously critical when it comes to managing any businesses. Now, when putting a forecast together, it shouldn't just be a one-off exercise that you do to make yourself feel really good at the beginning of the year. This is how great the business could be this year. Look how awesome these numbers look. These should be something that are revisited. These should be something that are compared on a regular basis to the actual numbers. So you can forecast 1 month through to 12 months at a time. You can forecast for the quarter, whichever way is helpful to you. Ultimately, is the person actually owning the business, running the business to start with, it needs to work for you. And that plan can then be improved or updated as you go along, as you work towards a position to actually sell the business. Making sure that we look at why actuals are different to forecast, because over time that can actually help us improve the way that we forecast the numbers for our business. And when it comes to talking to prospective buyers, they're going to want to see historical financial information, but they're also going to want to take a look at future potential financial information in the form of forecasts. And if you can demonstrate to a buyer that your forecasts are reasonably in line with what the actual results are over the years, they can then see that they can place a little bit more reliance on the forecasted information, because ultimately nobody has a crystal ball. We need to have some sort of system or some sort of science behind how we're going to forecast the numbers for our business. So being able to show that we've got a good track record of forecasting accurate numbers means that we're standing ourselves in good stead with potential future buyers. Other things that we're going to be interested in looking at from the financial information on a management point of view is what our profit margins are for the different service lines and the different product lines within our business. Now, Becky again talked earlier on about the importance of profit being sanity. It's not just about the sales, it's not just about the income, it's about how much money is left over when I'm actually selling a particular product or service within my business, to cover your own salary as the owner of the business, to cover other employees' salaries, and to cover other overheads as well. How much ultimately is left? We want to make sure that we can utilize the resources that we have by way of our employees. So what are the utilizations percentage-wise of their time? Are they actually very productive? Are they made use of efficiently within the business? Or is there a lot of idle time where individuals might perhaps not be made the best use of? All of that information we can pull together when it comes to putting management accounts together. So we can really, really drill down into how our business runs, which again will arm us really, really carefully for what we want our buyers to see, potential buyers to see. Where we've got very profitable service lines and product lines, we can be looking at how those could be replicated. So we could have a mix of profit-making and loss-making items. Well, is there anything that we could do about the loss-making items within our business with a view to improving those numbers again? So all of that information comes from management reporting. How often management accounts are prepared is also really important. It's all very good and well having the forecast, as we said earlier on, and comparing those with the actual results on a monthly or quarterly basis, but also whether any action is actually taken is important. So notes from management meetings can go with those financial accounts, and they will then help to inform, again, buyers of a business, or to give you more information when it comes to looking at calculating a potential enterprise value, which we're going to touch on a little bit later. And I know Emma's talked about the importance of that number and when she was talking to you earlier on. Financial compliance that we've got there relates to things like filing dates, things like filing accounts with Companies House if you're a limited company, or filing your personal tax returns with HMRC if you're operating as a sole trader. Making sure that those have been filed within the filing deadlines after the accounting year end is going to be really important, and it's going to be something that buyers' legal teams are going to be paying a lot of attention to, not just from the income tax or a corporation tax perspective, but they're also going to be looking at things like VAT and PAYE, if those are applicable, dependent upon your business. Payment dates, making sure that those liabilities are paid on time. Looking to see if there have been any issues over the years. So if there have been any errors on VAT returns, if we've got a history or a record of inquiries from HMRC on particular sensitive areas. VAT inquiries are very, very common, mainly because they're filed more regularly than annual accounts. So HMRC therefore have a lot more information at their fingertips when it comes to looking at financial information that's been submitted. So buyers' legal teams are going to be all over the compliance, looking at things like financial standards that have been filed in accounts. So making sure that you're on top of those is going to be really, really important to ensure that you've got as robust an enterprise value that doesn't then end up being eroded as negotiations progress within the sale process. I touched briefly on cash flows earlier on when I mentioned about forecasting and budgeting. Obviously, cash flow is absolutely critical for any business. Cash is king is very, very common phrase, but it's important that things like payment of tax is managed very carefully, payment of VAT, payment of salaries. So the forecasting when it comes to making sure that clients are paying you on time and how you then manage that business within the other the money within the other liabilities of the business is going to be really, really important. So demonstrating a good track record, demonstrating sound financial knowledge is absolutely key. Other issues that we've got in there, streamlining operational systems. So potentially less of a financial issue, but certainly impacting on the financial side of things. Might include things like the use of cloud-based technology within your business. Buyers might be going to be very interested to understand the sorts of systems that you have in place, because they might be wanting to merge that with what they have. So if they can access that information and are familiar with the systems that you're using, it's something that they can then merge with their existing systems. That's going to be much more favourable. Automation of admin tasks as far as possible to free up your time, if nothing else, as an owner of a business, purely from the point of view of making sure that the business itself isn't completely reliant on you being there. The key when it comes to selling a business, ultimately for you as the business owner and the main director or sole proprietor of the business, is you want to be making yourself effectively redundant. If the client relationships, the supplier relationships are all dependent on those people dealing with you, then that is going to have a huge detrimental impact on the value or the enterprise value of the business when it comes to sale. Because if you're not going to be around longer term, then that is of less value to a potential buyer. So you want to be removing yourself as much as possible from the ongoing processes. So you'll be looking at potentially outsourcing some of the roles within the business that you don't need to be focusing your time on. Your focus when it comes to planning to sell is to make sure everything is as streamlined as possible within the organization, outsourcing things like the financial, the accounting function, outsourcing payroll, IT, HR, all of those sorts of things can be moved out. But that then will obviously have an impact on the finances, because if you aren't doing those tasks yourselves, then that needs to be paid for somebody else to do it. So again, having a good handle on your financial position will be able to tell you very, very quickly if you can afford that. And if we can't afford that, why can't we afford that? Let's look at the numbers. Let's look at what's not working within the information that we have available. We'd also look at factoring in talent and staffing within the operational systems too. We've mentioned the importance of utilisation of staff, but making sure that they're taking as much of the heat off you as somebody that is looking to extricate themselves from the business going forward longer term. Oh, that didn't work. There we go. So looking specifically at some issues that may turn off a buyer touches on a lot of what we've already talked about, really. So outdated use of technology or no technology at all. I've worked with clients before that have had very outdated systems, and it makes it very, very difficult to people to understand exactly what the financials mean. It makes it very, very difficult to interrogate the numbers within an organization because it's not a system that they're familiar with. One in particular that I worked with had spent an awful lot of money in having a bespoke system made that worked brilliantly, but over the years, that hadn't quite linked in very well with new systems that we use elsewhere within the business, and it just ended up being a huge hindrance. So keeping up to date with technology and cloud-based software in particular was going to be really important. Low utilization rates of employees is going to be particularly attractive if that's applicable for your business. So again, making sure that you're making the most out of the employees you have working with you, using them to delegate tasks to be able to remove yourself from the business. It's also going to help you be able to take a step back and look at working on the business rather than working within the business. Previous compliance or insurance issues, so that might be financial compliance, such as late filing of accounts or the late filing of a compliance statement with Companies House, or potential indemnity or employer insurance issues that you've had in the past. That's obviously going to raise a huge red flag for any potential buyer looking to come into your business. Over dependence on a few clients is not going to go down particularly well, particularly if you yourself as the owner have helped to nurture that relationship over the years. It's a higher risk factor when it comes to selling your business, in that if you were to no longer be part of that organization, are those clients going to be just as likely to stay, or are they going to potentially look elsewhere? Having more clients and a more diverse client base is going to look more attractive to potential buyers. Also having more, again, dependent upon the sort of business that you have, but for example, less compliance work and more advisory service is going to be more attractive to potential buyers. Large amounts of debt as well. So if you have a client base that historically take their time paying their invoices, that's not going to look very good. It's not going to look very good from two sides, really. You've got clients that aren't used to paying on time or observing payment terms within the business, but you've also got demonstrating a lack of process and systems internally, which should be chasing up the payment of that debt. It also potentially is going to highlight cash flow issues within your business, which again isn't going to look particularly attractive to dealing with any potential buyers for your business. So we want to avoid all of these. We don't want to be turning off any buyers. We want to make the experience as positive as possible. And as you heard earlier on, when Joanne was talking, the process of having the buyer going through all of the details, the financial details, compliance details within the business can be a very, very long and drawn out process. So the more you have prepared for this from as early as possible within the running of the business, the easier and the less daunting this is going to be later on. So this is where the focus on setting up those foundations within a business is so critical and can only actually serve to help you as your business grows. The last main part, while we're looking at the selling of a business, is the taxation considerations. So it's really important to highlight from the start here that the advice from any taxation position is going to be tailored to any situation. So there isn't any specific advice that I can give you here other than to highlight a few of the things that you would need to think about when it comes to selling your business and coming out of the other side of a sale while you've got this hopefully nice substantial lump sum for all of your efforts that you've put into your business. The main thing to say as well is that it depends on how your business is structured. So the taxation position is going to be very different for a limited company compared to a sole trader. And it also depends upon how you're going to sell the business. So are you going to be selling individual assets from within your company? Are you going to be selling blocks of fees from within the company, or are you going to be selling the shares of your company, in which case you're dealing with it as an individual rather than a company? There are some reliefs potentially available, which are on the next slide, but it's important to highlight the two different types of tax. So for individuals, if you're selling your business as a sole trader, or if you're dealing with the sale of shares for a company that you own, then that's going to be subject to capital gains tax. And the rates of capital gains tax are either 10 or 20%, dependent upon whether you're a basic or a higher rate taxpayer. That obviously depends upon the amount that you receive in terms of proceeds or consideration for the sale of your business. If you're dealing with companies actually don't pay capital gains tax. Companies only ever pay corporation tax. So they would absorb any and all types of income within their business and pay corporation tax then on the gains or the income in relation to monies coming in for the sale of business assets, if that is how the deal is structured. When it comes to different potential tax relief for individuals, each person gets an annual exemption for capital gains tax every year, and that can be applied to any assets that you might dispose of. So that could be shares, that could be investment property, and that amount is just over £12,000 a year at the moment. So selling shares, selling assets, selling a business as a sole trader, you would always have an element of that gain that would be tax-free. In the same way as individuals, we get a personal tax allowance for income tax as well. So we get the same sort of thing on the capital gains tax side of things. But then we've also got different types of reliefs that we can apply dependent upon what the right thing to do is. And this is where you have the help of experts, accountants, tax advisors, lawyers that would help to determine what the next step is going to be after you've actually completed the sale of your business. Business asset disposal relief used to be referred to as entrepreneur's relief. And it's very, very common relief. It means that even as a higher rate taxpayer, you're potentially going to only be paying capital gains tax at a rate of 10%, dependent upon specific conditions being met. But it's very, very effective. It's used very commonly in these sorts of transactions for individuals. Deferral relief is slightly different, and that would involve the proceeds from the sale of the shares in your business or your actual business, if you're a sole trader, being reinvested in something else, usually under some sort of enterprise investment scheme or something like that. And what that means is you would literally defer the payment of the capital gains tax until you perhaps then sold the new investment that you've just used the proceeds to buy, however many years down the line that might be invested in there. So there are different things that can be used to reduce the amount of tax that might be owed or delay when the tax actually needs to be paid. But that, of course, depends upon what your ultimate circumstances and what it is that you want to get out of your business. If you're wanting to sell your business to free up your time, to retire, then that's going to be very, very different to somebody looking to reinvest that money in something else, in another business. It might be that you specifically wanted to sell a business in order to invest in a new startup and take advantage of the tax reliefs available within the enterprise investment scheme, investments that you can put your money into. So having that ultimate end goal in mind is always going to be very important and will inform the different options that you have available to you. So there's a huge amount to take on board. There's a huge amount to think about when it comes to selling the business. And again, it feeds into exactly what Emma was saying. Quite often, individuals either start the process of thinking about selling, particularly females, and think, oh, this is just too much. There's just so much to think about. There's so much to do. I'm just not going to bother. I'm just going to wind it up. I'm just going to let it peter out, and I'm not going to go through all of this process because it feels like an awful lot of work. When actually the perspective needs to change, the perception of how the process works. Yes, it's hard work, but look at all of those years of investment that you yourself in time have put into your business. Why on earth shouldn't you then get to a point in the final years of when you're working within that business, that you aren't then rewarded for all of that effort that you've put in. So you've got your earnings that you've built up over the years, but then you've also got that lump sum in terms of the sale based on that enterprise value and the all-important multiplier that Emma talked about earlier on today. So the last part that I'm going to talk about is the other side of the coin with these transactions, and that is to think about planning to buy. Now, this might be something that you would want to do as part of your long-term plan to sell, in that, as Emma said earlier on today, it can actually demonstrate that the business as a whole that you're selling, having already amalgamated a purchase business, demonstrates that you've got something that's worthy of sale. You've done it before, you know exactly how these things work, and you've demonstrated successfully that it can be done. So actually having plans to buy organizations, businesses within your longer term plans can really help when it comes to selling later on. But when you're actually looking at the buying part for another business, this is your chance to turn detective, again, obviously with the help of expert support from the legal side and the accountant side of things. You get to be able to look at your potential target businesses and look at just how robust those businesses are. There will be some information that you will be able to access as part of a public record in some scenarios. So, for example, limited companies, their accounts are filed with Companies House, albeit usually they're abbreviated or abridged accounts. So very little information you can get from those. But what it is that you want to see is the more detailed statutory accounts, as well as their management information. So all of the things that we were talking about earlier on in terms of their forecasting, how accurate has their forecasting been over the years? What's their financial compliance been like over the years? Have there been any problems when it comes to filing deadlines, paying tax on time, managing cash flow, things like client disputes, any legal issues or problems with employees? You get to look at all of that information when you're looking at the deal from the other side of the coin. Other things that you would want to look at are just exactly what would you be getting as part of the purchase of another business. Are you going to be inheriting employees, for example? What sort of talent is going to be coming across to be able to work with you and come with the existing business? And what financial systems? How are those systems going to merge, going to be able to be combined with your existing business that you have in place? Probably one of the most important things when it comes to buying a business, in the same way as it's important when we sell, is how redundant, how easily is it to remove the current owners from the business? How pivotal is it that they actually be there? What are the client relationships like? What are the supplier relationships like? Are there going to be any issues when it comes to removing that individual? Will you negotiate a certain amount of time for a handover, which is usually pretty standard on these sorts of deals? What length of time is that period of handover going to be? And what part is that person going to continue to play within the business while you're taking over the overall management of the organisation? Joanne talked earlier on about looking at contracts. You might need to be reviewing things like lease agreements. Are those things transferable? Is that something that you actually want to be taking on board? Or is that something that you want the business to actually settle up, to remove those liabilities, to pay them off, to renegotiate the contracts before you actually buy into that organisation? All of these things are really, really important considerations when it comes to whether you're actually wanting to buy into that business. Another really important aspect, and perhaps the most important aspect, what happens to the numbers that has been provided by the seller, the potential seller, if we take out their remuneration package? So looking at how they operate the salary, perhaps a dividend if it's a limited company. Have they got any benefits in kind that they put through the business? They might have a company car. payment for medical insurance, all of those sorts of things. What happens to the numbers and the profitability of the business? Again, dependent upon the structure of it. If all of those items are removed, and how is it going to be impacted when you put your own plans for your own remuneration into that business? Do the numbers still stack up when it comes to switching out somebody who will no longer be working and operating within the business? I've actually covered a lot of these already. Other considerations in there: what are your remuneration requirements, independent systems being amalgamated, those sorts of things. So obviously there's a huge amount to take into consideration when it comes to buying and or selling businesses. And hopefully all of these points have highlighted just how important the planning element of going into these sorts of transactions is. Having an idea from the start of your business of, I am going to sell long term, or as part of my journey, I want to buy an organization, buy a business in order to grow much quicker, with a view to then exiting again much quicker, either with a view to reinvesting in a different business or retiring early with all of the cash that you've been able to make, with the support of legal, mindset, strategic and financial experts to help you along the way. All of these things are more than possible to do. So we all stand alongside Emma when we say how important it is that with awareness, with knowledge, we can take away the fear. With systems and processes, we can take the emotion out of these sorts of transactions, and they really don't need to be something that we are fearful of or that we run away from. These are the sorts of transactions that we want to be encouraging, in particular female entrepreneurs, to be thinking as actual possibilities, thinking as something that becomes a normal part of running a business, of running your business. So there we go. And the final slide there is how you can find me.
Thank you, Tanya. That's been absolutely fantastic. I mean, when I have clients come to me before that want to buy a business or sell a business, actually, I mean, obviously the role of the financial accountant or a finance division, if they have one in their business, if they're a corporate, is actually probably one of the very first stages, like you say, because if you're buying a business as a buyer, you would ask to see the management accounts, the statutory accounts, and then, as you were just saying there, you would then use those to decipher the costs within it, see what financial synergies are in there, and come up with your own valuation for what you're going to offer for that business. So obviously the role of the financial accountant or your finance team is imperative when you're buying a business, because actually they're probably the first stage in the curve when you go through the full buying process. And again, when you're selling a business, the first thing I tell anybody who wants to sell their business to do is go and see your accountant, because they're going to advise. They know your business. They're going to tell you the best way to structure it, the best tax efficiencies to have, and the best way to structure your deal and sell it. And again, they'll probably give you they'll give you like a guidance on what your enterprise value is as well, because as I said earlier, there's lots of different ways to value a business, and it obviously depends on what aspect that you're looking at, the stage of your business as well, what's being included. So yeah, obviously your finance team is an imperative part of the deal team that I mentioned, and that's the first part of what the dating system is making sure you've got that deal team together, because you need your team of subject matter experts within your deal team to advise you on all the steps of buying and selling businesses. So yes, financials is one of the key most important parts of buying and selling businesses.
Absolutely. Yeah, it's quite often the first step where things are going to fall apart. You would know at that stage if something's viable or not. So yeah, absolutely, being able to understand and translate and interpret what's presented is a huge step.
Absolutely, absolutely. Well, thank you so much. I know you're coming back tonight this evening with us at 7:30 for
I
the.
am indeed.
I keep referring to it as a loose
Thank
women
you.
panel. I need to get a better, maybe level up panel. I think I'm going to call us
I've
rather than
laughed
loose
all day
women.
at that. Every time I've heard you say it. So, oh, I must tell my husband I've been called a loose woman 4 times now. I don't think he'd be
I'm
very
gonna,
impressed.
I'm gonna refer to us as a level up panel. I think. So.
I think we should keep the loose women. I think it's going to stick now.
So obviously we'll be back at 7:30 this evening to go through the long list of questions that I have and just have a bit of a maybe debate as well in some ways on the
Yeah,
importance
absolutely.
of female entrepreneurs thinking this way and not think that where they're not thinking of their business as an asset. They really need to think of it as an asset and not just close the doors as their exit strategy. That they've built up this business that has a value, and they really should be, using, releasing that cash
Oh,
really out of the
absolutely.
business. So
Absolutely. I
perfect,
couldn't agree more.
lovely. Thank you so much, and we'll see you back again at 7:30.